In this video, I want to talk about 4 stocks to buy in this market decline. The 4 stocks we are going to talk about are Games Workshop from the UK, Intercontinental Exchange from the US, Waste Management from the US, and Elan Corp that I think nobody knows in Japan. If this is of interest to you and you want to know the pitch and why these are good buy opportunities, this video is for you. I think these are 4 companies with a lot of potential, and now that the market is declining a little bit, these stocks are declining a little bit. This may be some good entry point for these 4 stocks. Okay, so we will talk about the numbers, the fundamental analysis, the growth rates, and the valuation, so you can see if these are good opportunities for you. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I've been doing 25% per year, investing in quality stocks. And the 4 stocks I want to talk about today are quality stocks, quality companies that you can buy and hold for the long term. So let me start with the first one, and you will understand my point. The first company I want to talk about is Games Workshop. Not a lot of people know this company because this is a company for gamers. They sell miniatures, toys in the Warhammer environment. Not a lot of people know this license, so let me just read the description. Don't worry, the financials of this company are incredible. So maybe you are not seduced by what they sell, but you will be seduced by the fundamentals, okay? Games Workshop designs, manufactures and sells fantasy miniatures and games-related products. It carries the manufacturing activity in the UK and sells the same in the different regions of the country such as Continental Europe, North America, and Asia Pacific. Yeah, they sell their toys worldwide. It operates through 2 segments, core and licensing. The core segment includes all revenue and expenditures relative to the design, manufacture, and sale of their fantasy miniatures and related products. In simple words, they sell expensive figurines that customers have to paint at home, and it's a plateau game, so you can play with your friends with your figurines that you have painted. That's it. And over the years, the prices for these figurines, the prices have increased, but this is such a good game. People are such hardcore fans that they are willing to pay up. You can have a box of figurines for $100 and people will play. You have a community of hundreds of thousands of people, if not millions of people playing the Warhammer license. And I've been aware of this license because I'm a gamer. For the past 20 years, I've been playing video games. I know very well how this community works. So yeah, it's not only a plateau game, a figurine company, it's a community for hardcore customers. So you have a moat because the clients absolutely love your figurines. They love your products, okay? So absolute moat, the name, the environment, nobody can really copy what they have built. They have a huge ecosystem. So that's a little bit of qualitative analysis before we dig deeper into the numbers. And so that was for the core part, the core segment, but you also have a licensing segment. Basically, you get your IP, your fantasy world, and you can adapt this ecosystem with new games, video games, series, animation series on Amazon, for example. So the licensing segment includes all revenue and expenditure relating to licenses granted to external partners. The company generates majority of its revenue from the core segment. Yes, this is what is important, the sale of the miniatures, the figurines. Now that you know the pitch, now that you know what they sell, let me show you exactly the kind of games we are talking about, the kind of moat we are talking about. This is it. You have understood what the business model does. This is it. Warhammer shop, you can go to their website. You will get expensive toys, $100 for a set of toys. And this is a serious game by run by serious customers, and the ecosystem is great. You can't have the same philosophy if you have a Chinese copycat, for example. Everybody has the same game and you need a few players to play. You need to have a new set of figurines. Anyway, that's maybe the purpose of a deeper analysis for another video. Just I wanted to make this quick video about 4 companies, so I won't go very much in details. But that's a very interesting company, and I've been following this company for more than 5 years now. Okay, if I look at the margins for this business, even though it's only a small figurine company in the UK, gross margins of 70%. Boom, that excludes all the other figurine companies because this company is special. Gross margins of 70%, operating margins of 40%. They sell toys. Net margins of 30%. This is huge. And if you scroll down, you will see that the revenue is up and to the right. Beautiful. The net income is up and to the right. Beautiful. They don't have a debt problem. They are filled with cash. The operating cash flow is up and to the right. The free cash flow is up and to the right. They pay half, 50% of the free cash flows as dividends because this is a company from the UK. So if you look at the CAGR for the past 10 years, since 2015, you have a CAGR for revenue, compound annual growth rate CAGR of 19%. Crazy growth for a simple figurine company. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. If you scroll down, you look at the net income, you have a CAGR of 30%. It's not a normal company. It's not a normal figurine company. This is what I try to say. And if you look at the earnings per share, well, it's similar, 33%. They don't do buybacks. Okay. Similarly, for the free cash flow, over the past 10 years, the free cash flow has grown by 36% per year. We are talking about levels that we see for tech companies, AI companies. And this is a small, hidden, UK-based company that nobody really knows. And they have been growing meaningfully. If you want a little bit of history about the business, they had a CEO, Mr. Kirby, that was here for many years, and they capitalized on some games in the past, like Lord of the Rings, Plateau games, and then the hype faded away. So you needed a new management, a new CEO, and this is what the company had. Kevin Roundtree, a new CEO, came in 2015, and this is what the results are. You have before 2015 and after 2015. Big before and after story. The new CEO is about efficiency, it's about community, it's about passion for gamers, and it's about cash flow. Exactly what we want as investors. So now you have a company with a proven CEO, proven management team, proven business model, focus on efficiency. If you look at the margins, you have sky high gross margins, 70% gross margins for, again, a toy company. If you look at the operating margins, since the new CEO arrived in 2015, the operating margins went from 13% to 40%. It's a huge change. And now the company is printing cash. Net margins, same thing. Free cash flow margins, same thing. And they recently had a trading update, meaning an update on their reports, earnings. And twice in a row, they upgraded their guidance. So they don't care about interest rates. They don't care about trade war with China and the US. They don't care about inflation. They will just increase the prices of their miniatures as they have been doing for 10 years now. And players are so in love with the brand, they will pay up because they have no competitors. I see what you are thinking right now. What about the competition? Do they really have a moat? They don't have competitors. You only have one Games Workshop, one Warhammer license, and one ecosystem like this. Literally no competition, so they can increase their prices every year. And players have no choice. Okay, so now it's about efficiency, cash flows, and you have a nice dividend yield of 2 or 3%. And what about the valuation? The valuation, no, this is not for this one. Let me check the valuation for Games Workshop so you understand my point. The stock has dropped. And actually, I'm monitoring the stock every day because I want to buy. I want to buy Games Workshop, and I think this is a pretty good buy opportunity right now. You have, for a business that grows free cash flow at 30%, again, I repeat, a PE ratio of 24. If you click on segments and KPIs on Fiscal AI, by the way, I'm browsing across different websites. I'm using Fiscal AI here in white, and here in gray, I'm using Stock Unlock. If you want to use these two websites, I mean, I've been using them on a daily basis. You have discount codes in my description. Just go to my description, click on the links. It will be cheaper for you. If you click on Fiscal AI on segments, you have trade, retail, online, core, licensing. You have plenty of information. What matters is the core revenue, the selling of toys. You see a clear improvement for the past 10 years. And from what I've learned about the business, from what I've read, there is no sign of stopping. Now that markets are rather expensive, AI companies are rather expensive, you have a lot of hype, quantum computing, you maybe want to be invested in companies that have nothing to do with AI. Here we go. Games Workshop, reasonable valuation, growing profitably. Now the stock is down 12% from all-time highs. The stock has pulled back a little bit and the valuation became reasonable with a PE ratio around 25. Price to free cash flow around 23. Look at this, 23 here. So it has become reasonable for a business that is upgrading their own guidance. I mean, you don't see a lot of red flags for this business and the ecosystem is still intact. So that was for the first one. I will maybe buy it in a few days. So very interesting, and I wanted to start this video by showing you this. You can continue the due diligence on your side, but I think this is pretty interesting. The second one is more boring, but it's more famous. It's Intercontinental Exchange. Okay, you probably know this company. It's a vertically integrated operator of financial exchanges. They own the New York Stock Exchange and provides ancillary data products. So it's very famous because they own the New York Stock Exchange, but they also do other things. What I want to say is this is a quality company that has been growing for a while. If you look at the fundamentals for this company, look at this. Consistent track record of growth. Over the past 20 years, the earnings per share have been growing at 15% per year. The growth story is still intact, and yet the stock is down. The stock is down 20%, and now it has reached a reasonable valuation, I would say. If you look at the financials and the valuation, you will see that this is a very reasonable valuation right now. You have a valuation that was very high with a PE ratio of 40, and now we just broke below 30. I would say reasonable valuation for an excellent business model. If I show you the fundamentals, you will see that they have gross margins of 50%, operating margins of 40%. And if I scroll down on the charts, you will see that the revenue is up and to the right. The free cash flow is up and to the right. Look at this, in blue, the free cash flow. The net income, not so, but you have some inflows and cash flows. What is important for this company is the free cash flow. You see strong improvement in free cash flow every year. The disruption risk is very limited for this company. So if you want to buy a quality stock right now, that will be a perfect hedge for inflation, you can buy this one. You have now a reasonable valuation for a business that can grow 10, 15% per year. If you buy right now, you are very much hedged against a lot of risks, I would say, in this market. You have a forward PE ratio of 20 for this business. If I check the forward PE ratio on Fiscal AI, you will see. Here we go. In a few months ago, they had a forward PE ratio of 26, now 21. That's a meaningful drop. That's a meaningful drop. That's a 20% drop. And now we are back to the levels we saw in April during the market flash crash of April. So yeah, a lot of pessimism. The stock is literally going down and only down right now, and nothing fundamentally driven. It's all about sentiment. And as always, it's very likely it rebounds from there. As always, as the business is continuing to improve over the years, it will improve the stock price over time. Let me show you some slides that are interesting. You have a business that is still growing revenue by 9-10% per year. The free cash flow is up 14% per year. The business model is not broken at all. The earnings per share are growing by 19% per year. You still have buybacks, growth, profitability. You can buy a very, very good quality business at a reasonable valuation right now. This chart is quite telling. Every year, you have an earnings per share that is improving. Every year. Okay? Let me go to the third one, that is waste management. I covered waste management a few months ago on my channel, saying it's a buy and a hold forever stock. And at the time, the valuation was a little bit high. But since then, the valuation has dropped. The stock has gone nowhere. The stock, see, for the past year, the stock is flat. 0.25 actually. So you probably know waste management. They are the largest integrated provider of traditional solid waste and medical waste services in the US. And they are in the garbage industry. This is boring and nobody wants to touch this industry. You have nothing to do with AI. You have nothing to do with tech. You have nothing to do with NASDAQ. So nobody talks about waste management. And this is still a quality company that is improving their revenue every year. Look at this. An improvement, a little bit up and to the right. Net income is following the same trend. You have an improvement. You have free cash flow. Let me show you the free cash flow. Quite stable. You have a little bit of growth, but this is not sexy at all. And they do buybacks. So a lot of elements of quality companies that don't rely on NASDAQ, on the AI bubble. Again, if you want to be invested in a company that will not crash when the AI bubble pops, well, here you go. You have a business that is profitable and a forward PE ratio of 25. I want to mention this company because the valuation for waste management was always high. And now finally, it's reasonable. Finally, it's reasonable. So it may be of interest for my audience. Let me show you the forward PE ratio for this one. Come on. Okay, forward PE ratio. Here you go. When I covered this company, they had a forward PE ratio of more than 30, I would say. And now it's back to 26. Much more reasonable valuation. The stock has gone nowhere and the fundamentals have improved. To some extent, valuation went down. And here we are, again, back to the valuation we saw in April, back to the valuation we saw in December, almost 1 year ago. I believe this is a good moment to accumulate shares if you are hesitating. Not a lot of things can disrupt waste management. This is a very boring compounder that will continue to compound. Valuation is not reasonable. Valuation is decent for a company with a huge moat for the future. So yeah, this was for the third one. And let me conclude with a stock that you probably don't know. A company you probably don't know. It's a small cap in Japan. We have covered this one inside my coaching program. It's called Elan Corp. The ticker symbol is 6099 and it's in Japan. So you don't have a lot of YouTube videos on Elan Corp. It operates in the medical industry. Basically, they help hospitals, nursing homes in Japan with their towels, with their clothes. And every day they come to see the hospitals. And with the reusable growth, I think if you go to the investor presentation, you have the elements they rent. You have towels, personal care items, drinking cups, tissues, shampoo, and clothing. Because as you probably know, Japan has a demographic problem. You have a lot of old people over there. So hospitals are working a lot. Nursing homes are working a lot. And Elan Corp is helping them, giving them daily clean towels, cups, clothing. So hospitals that are having too much work can relax a little bit. And this is a company that is partnering up with more and more facilities. Look at this, monthly users literally up and to the right. They help more and more people, and they continue to grow and grow and grow. And you have more nursing homes, etc. You can go to their investor relations page and you will find some nice slides. They are focused on Japan, and I believe they can expand internationally. Now, you may be doubtful of this business model. Let me show you the fundamentals. It's a market cap of $300 million, very small, very tiny in Japan. And look at all these beautiful charts. The revenue for this business is up and to the right. If I go to, what can I show you? To Stock Unlock, I can show you the CAGR, the annual growth rate for all the fundamentals. For the past 10 years, the revenue has been going up 20% per year. Okay? The EBIT, operating income, 21% per year for 10 years. The net income, 22% per year. The cash flows, free cash flow here, 32% per year. Now, net income is down a little bit. At the same time, operating cash flows are up a lot. So I won't spoil you the fun, but you have some good working capital efficiencies. Now they are generating a lot of cash flows, and you have a price to free cash flow of 13 for this business. A forward PE ratio of 14. So very cheap, zero debt, filled with cash. If you compare the cash with the market cap, you have what? A market cap of $320 million and enterprise value of $290 million. So you have 10% of the company sitting in cash. And if you believe this demographic problem will continue in Japan, well, you will have more demand for Elan Corp. And for the past 5 years, Elan Corp has done nothing. No returns for shareholders. But it's great for us long-term investors because, as I just showed you, the fundamentals are improving. The fundamentals are improving, and now the valuation is down. When we discussed this company inside my coaching program, we said the valuation was a little bit too high, maybe not warranted for this business. You know what? Let me put forward. In the past, like 5 years ago, this was a company with the EV to free cash flow of 40, 60, 70. The valuation was just too high. I mean, if you want to use a more simplistic approach, you can look at the PE ratio. You will have approximately the same trend. In 2020, the PE ratio was 75. So similarly to what we see for MSCI, for example, or Lululemon, stocks were very expensive. And then the stock went down and down and down and down, but the fundamentals improved. And this causes the valuation to drop significantly. Now you have a PE ratio that is at 20, but because they plan to continue to improve their operations, forward PE ratio of 13. So reasonably priced, I would say cheap right now. It will not be available on all the brokers, but I believe if you have the chance to invest in this one, it may be a very good moment to buy Elan Corp because of the TAM, total addressable market, this company has. It's hidden, it's unknown, but the fundamentals are here and the free cash flow keeps growing and growing and growing. If you look on a quarterly basis, the revenue is still turning up. No problem whatsoever for this business. The company is still thriving and now we have reached a very good valuation. So yeah, this was the fourth stock to buy. I believe if you buy these 4 stocks right now, you have a very good chance of outperforming the market. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.